Michael, how do you pronounce your surname?
Okay, the webinar is...
How you pronounce your surname? Merle?
Good morning.
However you like, Michael Merle.
Okay.
Merle, it's actually a French name, if you believe it or not.
All right, yeah, perfect.
Brilliant. Yeah, there's nothing like some pronunciations. I was trying to dodge them myself, but luckily I got a few moments with Laurent just in the waiting room. So welcome everybody. We can see from the screen there that you're in the right place for this wealth creation summit. And I'm only going to talk for about 10 seconds because I think that the room is coming. I think we're just starting to level out now. So what we're going to do is then everybody will be on mute. The text chat will be open. It's completely live. And now that everybody's in, I'm going to hand over to the host, Scott Phillips.
Well, actually, I'm not the host today for once. The host is my good friend, Antoine. So
all right. Good morning, everyone, wherever you are in the on this planet. I'm really happy to be here with you and with those amazing people for this Wealth Creation Summit. So I prepared a few questions for them, and I hope they're gonna help us to navigate through this really different time of economy. I think this is really different than what we have since the last 15 years or something like that. So first of all, on the crypto market, we had the FTX that totally collapsed. So that creates maybe a domino effect. We will discuss this later. There's also the US dollar, who is finally discovering gravity, and tension in Europe that's have been highest than ever. So we're going to have some turbulent years. We're going to have some exceptional time. And I think during exceptional times, we need to take exceptional measures. So that's what we're going to see today is with those experts. They're going to enlighten us of which direction to take for our investments, how to protect our capital, maybe even make money during this time. So, I mean, let's get started and let's introduce our panel. So first we get Laurent Bernu. Laurent Bernu rose to the elite of the hedge funds world with a high unorthodox career path, Frenchman from New Caledonia. It's always appreciated to get more Frenchmen on the panel because yes, I'm French as well. So he was educated in Paris and entered the hedge fund industry in Japan, where he lives now with his wife and children. And I can see that he loves the good old banknotes, as we can see his background with the Reserve Bank of Zimbabwe, $100 trillion. All right, so what Laurent is specialized in is for systematic trading, particularly a short seller. So he worked for Fidelity and other large funds. So short selling is quite interesting because I never short sell before I used the CSI system. So that was something that was pretty scary for me. And then because I think to be a short seller, you need to be a lot more skilled than a long seller. So welcome to you, Laurent, and how are you today?
Bonjour, Antoine. Thank you very much for having me today. It's an honor, it's a privilege to be here. I'm really grateful. Doing well out of Tokyo here. So as you said, it's always good to have more French people in there.
That's good. So I'm going to jump right in with some few quick questions so we know who we are talking to and what is your global opinion. So snap answer, what is your view on the stock market in 1 year? Higher or lower than or flat?
Oh, the stock market is about to have a rude encounter with Newtonian physics, so definitely much lower.
All right. And what about a 5 years time frame then?
I think we vastly underestimate the unraveling of the bond market. So we're unwinding a 40-year trade with easy money. So I would definitely put it lower. We might be flattish from the bottom.
Okay, so for people who are retired here, that's going to be even more important. What about in 10 years then?
Oh, well, there's a reason I have the Zimbabwe banknote here. So yeah, higher.
Higher, okay, interesting. And what about Bitcoin? Are you familiar with the crypto market as well?
Thanks to Scott, I've started to learn about the Bitcoin and cryptos. Well, if everybody's looking for a bottom, my experience as a short seller tells me, in my double decades of experience as a short seller tells me that if people are looking for a bottom now, we're nowhere near.
Oh, okay. So that's 1 year. That's not a good one. What about in 5 years or 10 years?
Potentially higher, and in 10 years, definitely higher.
All
Bitcoin is
right.
here to stay.
Okay. What about the interest rates?
Much higher in a year from now. Like people also underestimate if they talk the way the language, and you can if you can appreciate the language, much higher than people estimate.
And another big question that may create a disparity in this room, but China, will it surpass USA? Yes or no?
It's not about if, it's only about when and how. I mean, manufacturing has moved to China and it's not coming back.
Okay. And another last question. Will Bitcoin remain the dominant crypto or be overtaken? What's your opinion on this?
Bitcoin is I have no idea, to be frank, but Bitcoin has been the gold standard. I mean, it defines crypto. So I would defer to other members of the panel much more qualified than me.
All right. Well, that's perfect because we're going to go with our second guest today and introducing Michael Merle. Also, he's not French, but he got a French name. Also known as the Evil Speculator. He's also the founder and president of Red Pill Coins, amazing website. And Michael was a senior Silicon Valley engineer who retired from the industry up in 2008 in order to pursue his passion, which is to trade for a living. He has been widely successful as a quant trader and also as a blogger, running one of the most successful trading blogs of all time. And in recent years, Michael co-developed the automated wealth creation engine with Scott, and I used it as well. And also a still incredible consistent option trading system with real world long-term win rates over 80%, which is going to share with our viewers. So Michael, welcome. Happy to have you here.
Thanks.
You're gonna go through the same test as Laurent, the choose test,
Okay.
snap answer. What is your view on the market in 1 year?
Yeah, in my mind, we're looking at a market correction, significant market correction. It's long overdue, and we're working our way up to it. So yeah, probably going to start in Q1 of next year.
Okay. What about in 5 years? Are you more positive or?
Well, I only regret that I don't have the 10 billion Reichsmark, banner behind me, because I'm with Laurent on this one. One way or the other, inflation is basically baked in the cake. So just by that, in dollar terms, I would expect the market to be trading higher in 5 years. But what that means is a different story.
Interesting. Well, we're gonna dig into that later, I guess. And what about in 10 years then?
Oh, it's a long time, 10 years. Historically, the average return is 10%, so I'd say higher.
Interesting. And what about crypto then? What about crypto, Bitcoin, 1 year, 5 years, 10 years? What do you say?
Well, the longest bear market in crypto has been around a little bit under 2 years, right? So we're 1 year in now. I would hesitate to say that we're going to be higher in 1 year from now. I know that sounds weird, but in 5 years, definitely higher. In 10 years, no brainer. Bitcoin's not going away.
Perfect. Interesting. And I have my opinion on this, but I guess we will discuss that later. And what are you thinking about the interest rate?
If you're referring to the Fed funds rate, right now we're at 4%. I think 3.75 to 4, and I'd say higher. So higher 5 years from now, and a whole decade, of QE. It's left its mark. In my mind, we've left, deep mark on the economy. I think it's hard to predict, but probably higher in 10 years from. We're not going back to zero.
Yeah. When you say higher, are you talking mostly about USA or we're thinking like global?
Well, everyone else is being dragged along. I mean, we can talk about this later, but I think everyone is dragged along by the US at this point.
And what's your take then on China and USA?
Surpassing the US? Well, in many ways, China has already surpassed the US. I mean, anyone who's been to Asia, right? And when it comes to manufacturing and all that, definitely new global economic alliances, BRICS nation now and all this stuff, Saudi Arabia joining, it's on a long-term basis. I would not count out the US though, and especially now, you know, that it is so connected with Europe. I mean, we're dependent, I mean, Europe as well, we're connected to the US now, energy supply. So I think it's hard to say, we'll see.
Okay. All right. And the last question, is Bitcoin going to stay the king in crypto, or we're going to see him falling down?
Well, I'm with Laurent. Bitcoin has always been the gold standard, right? With Ethereum, kind of like it's silver equivalent. It's more, has a little bit more utility up to this point at least. And I don't think it's going away. It's always going to be the granddaddy of crypto, currencies. And I think one way or the other, it will remain dominant. Absolutely.
All right. Well, we're gonna thank you, Michael. We're gonna finish our round circle with Scott Phillips. So I guess most of you here know Scott Phillips, so he needs no introduction, but we're gonna still do one a little bit. He's an expert in trading system designer, and that's what he's most passionate about it. Actually, that makes like when you have a dinner with Scott, sometimes the conversation can go really nerdy, because he will explain you how you want to design a trading system and things like that. So, but welcome, Scott. Happy to have you here. Well,
thank you, my friend. I'm really happy to be here. And yes, I am a boring dinner guest. All of the panelists here are much smarter and much more knowledgeable than me. And Antoine hasn't blown his own horn, but he is the most knowledgeable altcoin and crypto trader that I know. So his expertise and his opinion is very much the most believable out of everyone on the panel. So when it comes to crypto, pay attention to him.
Thank you, Scott. Appreciate it. All right. Well, you're going to go on the same road as our other friends. So be ready. Stock market in 1 year, what's your take?
Lower.
5 years.
Flat.
10 years.
In nominal basis, wildly higher. In real basis, flat.
So there's something we're going to study later that seems really, really interesting. But that's connected actually with Bitcoin. Then your opinion in 1 year, 5 years, and 10 years?
I think we are close to a bottom, but like Laurent said, when people are calling for a bottom, it's not a bottom. You'll know it's a bottom because nobody thinks it's a bottom. People think it's over. So I think we're probably 90% of the way to a bottom. And we'll have a bottom in the next 2 months. Probably.
Okay.
So higher in a year, higher in 5 years, very fucking higher, like ridiculously higher in 10 years.
And China with USA.
My unpopular opinion is that China's going to lose. And the reason for that is that historically, we seem to have forgotten the Cold fucking War. Totalitarian governments eventually start making stupid decisions, and eventually centrally planned economies make stupid decisions, and democracies make better decisions over time. We've already had that experiment for a couple of 100 years, and we're already seeing China starting to make stupid decisions. With their COVID policies, with their Xi embedding himself for life, establishing a surveillance state.
I
think China's got a lot more problems than they're letting on.
Yeah. Well, I can know because I had a few friends living in China, and everyone is leaving. So like when the brains are leaving out the country as well, it's never a good sign. It's never a good sign.
I think it's about the tails, and the average Chinaman might be much smarter than the average American, but those aren't the people that matter. The people that matter are the 180 IQ people. What are they doing? And the best in America are the best in the world at innovation, at thought, at building new technologies. Silicon Valley is still, even with all its problems, the marvel of the world.
Yeah, that's interesting actually that we talk about demographic, because I think that's something that impacted Europe as well. Like all the brains flew out to Europe. They were like this. We can see we have Laurent Bernier in Japan. I mean, that's a proper definition of this. And so actually that's lead me to the next topic I wanted to discuss with you guys is about the trends that we saw that created the growth in GDP in stock market. What was the demographic? What was the thing that affected this around that? if Laurent, you have an opinion on how demographic have helped growth.
Sure. I
the
mean,
biggest change?
we've just crossed the 8 billion people mark. When I was born, we were at 2 billion. I was born when Donna Summer was on top of the billboard and so on and so forth. So, but more importantly than that, I mean, there's also the participation within that. We can see that since the women's participation, corrosive though it may be, feminism has done spectacular. Is been nothing short of a miracle for business. And I'm not making an ideological point. Within the space of 3 generations, we've moved from multi-generational households with grandpa, grandma, the family, and the kids, to nuclear households, to now daddy living out of his car in a single bedroom, mommy inheriting the house post-divorce, and the kids out there studying or OnlyFans or whatever that is. So, and it's not, it's not an ideological point. It means that we have now 4, when we used to have 1 fridge, now we have 4 fridges, we have 5 Netflix subscriptions, we have 5, and then we also have 5 lines of credit. So in front of the Wall Street building, we shouldn't have, like, instead of having a little girl facing the bull, we should have a statue of Gloria Steinem, because this has been phenomenal for consumption. And it's not, it's not an ideological point. So, and also if we remember that women constitute 75% of consumptions, that is, women consume 3 times as much as men. Not only that, they also represent 60% of student debt. So not only do they consume, but they generate more debt, which in turn creates more consumption. Does it make sense?
Yeah,
So,
actually, yeah.
Laurent, can I clarify? So this women in the workforce participation is as big a driver of GDP growth as the post-World War II baby boom and the baby boomers entering their prime years in the 60s, 70s, and 80s. Like, it's
Correct.
just, wow.
It's an accelerator. And it's interesting because normally people only see demographics, but when we look within that, the female participation and the propensity to consume, if you enter any department store, there's probably one floor for guys somewhere, and then the rest is for women consumption.
That's right.
That's why never go to the department store, guys. That's number 1 tip to save money here.
Okay.
That's an interesting take, actually, Aladdin. What is your opinion on this, Michael? Do you have anything to add?
Well, I'm even older than Laurent, and I was born in the 60s, and since then the dynamics really have really picked up, in terms of competitive pressures, and also household income. And Laurent already spoke about that, right? And of course, also divorce rates, right? They have really, really jumped up, along with fertility, drop in fertility, massive drop in fertility. In the US, we have right now it's around 1.6 births per woman. In Europe, it's even worse over here. On average, depends on the country, 1.5 per woman. So, you guys all know replacement rate is 2.1 births per woman. And so, in that space, if we maintain our current standard of healthcare, it's just not enough. And so if we are to rebuild our manufacturing base statewide or stateside, but also here in Europe, and move away from just service and finance-based economies, there will be steep hurdles that have to be overcome.
Yeah, so you guys don't really see the manufacturing going back to their home country?
Oh, I do. There will be an attempt. We don't have a choice. It's not going to be easy, though.
Yeah, because that will provoke drastic change, I guess. Well, first in supply chain and prices of how we consume. And what about you, Scott? We haven't heard you on this one.
Well, I mean, for me, the start of all this was going back to World War II. You had a whole bunch of people who would have grown old and required healthcare and social security. They died. And instead, we had the incredible boost in birth rates, like an amazing spike in birth rates following World War II. Those people got to be in their prime working years, my parents' generation. And in their prime working years, there was no old people to take care of, and they were earning and spending a lot of money in tax. And so economy's got this great big taxable boom where they didn't have to pay for the old people, and the young people were paying a lot of tax. And that is reversed now. And Laurent lives in Japan. It's the first country that's actually got old in the West. Like Japan is really on the tail end of a demographic whipsaw. And now all of a sudden you have this situation where people are in the young people are going to have to work longer, and they won't have this solid economic boom. You know, 30 years ago, you finished your degree, you got a job anywhere, you bought a house, you bought a rental property, you bought some stocks, and then you win the game and you retire in 30 years and you're rich. That playbook does not work anymore. It's like categorically not. So we're setting ourselves up for intergenerational conflict where, you know, young people, my daughter won't be happy about buying a house if that house doesn't appreciate in value, won't be happy about buying stocks if it's a low growth world, won't be happy about paying for my social security and my healthcare as I now live to 100 instead of living, you know, the age pension, the average age that someone lived to used to be in the low 60s. I can't remember the exact numbers, but when yeah, Laurent.
Oh, sorry. Sorry, I interrupted your train of thought. But did you know that actually you're talking about 60s life expectancy? The age of the pension was originally after World War II. Pension was created when pension was created at 60, when the life expectancy was 58.
Exactly, and now if you live past 60, you're probably going to live to 85, and plenty of people live to 100 these days. So we've got this. Whatever you think about the national debt, however bad you think the national debt is, it's nothing compared to the obligations for pensions and healthcare that we've promised but haven't set aside money for these old people, and that comes at a cost. That's just the only point that I'm trying to make.
Interesting. Actually, I've heard about the COVID babies. Do we have any numbers on that? Like, is that a smaller baby boom, or what are we talking about?
It's very small because birth rates have structurally declined to the point where we're not replacing our populations in the West anymore.
And I have some bad news about that. Have you heard of the COVID divorce rate?
Yep. I was just about to bring that.
That's a good point.
Exactly.
That's a contrast.
Yep.
That's a contrast.
But Laurent lives in Japan, which is already feeling this demographic thing, so he can probably tell you a little bit more about it that we probably don't have.
You know, when I came to Japan, it was amazing. You had all these, I mean, the native tribes, otherwise referred to as cute Japanese chicks. They were super young, super pretty, super horny. It was very hospitable. I mean, first time I walk into a bar, hey, you look like Brad Pitt. I'm like, whoa, darling. Last time I checked, he's tall, blonde, blue-eyed, and handsome. I think I'm going to love your country, which I did. And but now you can feel the vitality being drained. So there's a clear, I mean, Japan is a very cool country, don't get me wrong, but there's a clear loss of vitality. When you go, for instance, when you compare it to Vietnam, where 30% of when the people under 30 are the majority of the population, there's a very clear vitality that is being drained. You see, we're all born Democrats and we die Republicans. We're born to want to change the world, and we die hoping to preserve the world that we've grown into. And not only that, I mean, Japan has found an interesting solution. They import labor. So Japan, because it's an island, they can have their own demographics and it's very homogeneous. So they import labor, people from Uzbekistan in 7-Eleven, like Nepalese, and then they send them back after 5 or 10 years. So they don't have to worry about these people's pension. They get their vitality, their workforce, and then they send them back. But again, aging population is not good news for wage, for transfer of wealth, because the state also intervenes. So you can expect, like, what's that, inheritance tax to go higher structurally. Does it make any sense?
Laurent, you were talking about how an aging population is actually inflationary, which I didn't understand before. Would you mind fleshing that out? Because that really blew me away.
Okay, so a colleague of mine, when I was at FIDO, he mentioned a couple of studies done, white papers done in Sweden, and about like inflationary pressure for aging population. So I didn't really understand the whole mechanics of it. But typically there's like wage pressure for the, you can tell that the capital, the main asset that people have now is their youth. You're 23, 24, fresh out of college. Yeah, you studied ancient Greek. Yes. All right, come and sit on our desk. Whatever you did, it doesn't matter. You're young, we'll train you. So there's inflationary pressure for this. And at the same time, the only way for pension to be paid is to monetize them. So you pay people the same 50,000, 100,000 yen pension, but since there's not additional wealth creation, you need to actually you need to roll out the printing press. This is my 2 cents understanding on it. There are also mechanisms that I would have to look, I would have to read those white papers again. They don't jump to mind, but these are the main two things.
Okay, so if I'm understanding correctly, what you're saying is basically because of the aging population, we're going to see a much lower growth in the world going forward than what we used to be.
Old people don't consume the same way. Old people don't. Old people are quite happy with an old car.
Yeah. But I mean, I've seen also like where they see like, all right, the old generation, they have some money to spend because they accumulated some money, they have some real estate, things like that the young people don't have. So it's like their buying power seems to be still quite significant.
So their buying power is significant, but that's not spending. So owning five houses is not the same as going out and spending money, because that money doesn't flow around the economy. The major benefit of having an industrialized economy is you spend $1 in the economy and it gets paid to all these people who then spend it and then save it and then spend it and then save it. That's why the stimmy checks had such a huge effect, is because that money, it wasn't just because we gave away $1 trillion, it was because that $1 trillion got spent to the next guy and to the next guy and to the next guy. And old people don't do that.
Yeah, I guess they're a lot more risk averse.
They're trying to save? Like trying to save, young people are trying to spend. It's a fundamental.
What is your take on this, Michael?
Well, I live in Spain and moved over here from the US, and I see a lot of parallels with what Laurent described and down in Japan. And capital here doesn't flow very much either. We have a lot of generational wealth here actually in Spain. A lot of people always think of the Germans, where I was originally born, to have all the money. But in terms of like household wealth, it's actually more here in Spain. But then at the same time, we have got, 30% unemployment, more probably 40% unemployment among young people, below 25. We have this whole generation of miloristas, which is basically people who make €1,000 or less. So there is also certain concentrations in terms of spending power. And a lot, also what Laurent said, I found it really interesting, really, that he felt like the energy, right, the mojo had been drained out of the system, out of society. I feel the same thing over here. It's just, even I moved here 10 years ago in 2012, and it was so different than it is now. I think really, a lot of things have changed. And yeah, it's just very different, and it's not the same as it used to be.
Wow, that's crazy. Yeah, the unemployment rate in Europe is just through the roof. Well, it's interesting because I'm here. I'm in Thailand, same as Scott, and then the unemployment rate is like below 1%, something like that. So it's just so they will go from one job to another. They just don't care, and then even if it's a small job, they don't care. So that's really, really interesting with the West that act totally different.
Yeah, also we don't have an economy. What do we have? Do we make anything in Europe, especially you're European? What do we make? Do we have any software companies? No. What do we manufacture? Originally from Germany, all we have these old, giant, like Siemens. My father spent 40 years at Siemens, right? That doesn't happen anymore these days, right? The people don't come out of college, like Scott said, and learn a trade or study, right? And then maybe have one or two employees, right? Employers. That doesn't happen anymore. So that a lot of things have, if we want to go back to a manufacturing or resource-based economy, a lot of things have to change, and I don't know how that's going to change, especially culturally, because politics is downstream of culture, and I think unless there's a cultural shift, I don't think it's going to change. So a lot of hurdles to overcome. Yeah.
If
Guys,
I may,
let's keep it moving. Sorry, Lauren.
if I may echo the wisdom of Michael, Tim Cook at Apple said that, okay, it's nice to wish manufacturing to come back to the US, but if we want to manufacture, we need the engineers. In China, you can have 2 football stadiums of engineers who can polish an iPhone, and in the US, you wouldn't even be able to fill up a boardroom. So there's also that aspect. So
Yeah, here in Spain as well, if I want to throw us in real quick, we just moved into a new house. We had the hardest time just finding a plumber, just finding somebody to install things for us. I had to do half the things myself. It's without connections, but we can't even find people to work. And people don't have much money, but they also really not that interested in work either. I'm not saying the Spaniards are lazy. I see that, and read German news. My friend, I understand a little bit French. It's the same in France. It's the same here in Spain. And I'm hearing, I have friends in America, and I'm hearing the same thing in America now. So it's some kind of cultural disease that seems to be taking over in Japan, obviously, in Asia, in certain parts, but also here in Europe and in the West across.
Let's keep it moving. We got lots and lots to get through. Let's not get bogged down.
Let's move on and talk about the interest rate. From 1981 until 2021, interest rates fell almost every year. This caused an incredible multi-decade bubble in bonds and enabled speculative bubbles in virtually every asset class, from property to crypto. Laurent, would you mind giving your take on the interest rate regime? We are just coming out of it, and what is likely to change and why? I don't really see how it's going to change for me, because I'm 30 years old, so that's basically what I knew from the economy.
All right. So, sorry, it's going to be a bit of a long-winded answer, but Scott and myself, we met on Quora, and back in I think it was 2018, somebody asked, what do you think about the next bear market? And I said, you don't have to worry about the next bear market. You have to worry about the one thereafter. Einstein said, don't worry about World War III. But that World War IV will be fought with sticks and stones. So the idea behind this is, in 2018, when the question was asked, the answer would be, oh yeah, you know what? Don't worry. I mean, the Fed, they will burn the furniture to heat up the building. They will sell their in-laws, as they should. Always sell your mother-in-law. And so they did that in 2020. And then they propped it up with zero interest rate. With the system is sloshed with money. And then in November 2020, I was what is going to happen next? What would make them stop? So reason number one is, all right, valuations are frothy. No one in the history of markets has ever woken up and, hey, you know what? I believe that valuations are a bit rich. Price is a bit rude. We should correct this market. No, it has never happened. The bond vigilantes, Larry Summers, Ed Yardeni. All right, guys, let's teach the bond market a bit of table manners. That as well doesn't work. But on the other hand, inflation. Now, inflation is back, and inflation has been tenacious. So all the monetary authorities around the world have a dual mandate: employment, inflation. And when they have to make a choice, inflation always wins. They don't want, as Michael said, they don't want to have the Weimar Republic Mark. They don't want to have Zimbabwe. Thank you very much.
Laurent, can you just flesh out, because I don't think people really understand how bad embedded inflation is for any country. Can you just flesh out exactly why that's bad, exactly why the central banks will do anything to avoid that, like why that's the nightmare scenario?
It's very simple. If you look at the riots back in the 80s in South America, and everywhere where there's high inflation, there's political instability. There are peoples on the street. And inflation is a monetary phenomenon, but above all, it's a political phenomenon. Politicians, like hookers is the first hookers is the first job in the world. The second one is politician. They learn from the first one, so they know they have to react.
So
It gets people on the street and angry.
What I'm hearing from you is that every single place, everywhere in the world for the last 300 years that we've had embedded inflation has political riots and eventually revolutions, like almost as night follows day. Like if you want your country to fall apart, have 5% inflation for 10 years, your country will be pitchforks at each other.
Absolutely, absolutely. And this is like the fiat currencies, what we have fiat currencies now, there's a history of collapse. There's a track record of collapse. So they want to avoid that. Like the Germans in particular are scared shitless of hyperinflation. Look at what it brought about. So, hey, Michael, for all your wisdom, I mean, my apologies, but I mean,
no, you're too caring.
So the analogy that I keep coming back to is that this money printing is like a heroin addict. They just need more and more heroin that just to get them back to normal. Like it's not even getting them high anymore. We need so much money inflation. So we need so much money printing just to kick the can down the road. And there's no real prosperity being generated anymore. It's just keeping it going, right?
So basically the idea there is that to combat obesity, the monetary authorities have rolled out a federally funded free cheeseburger program forever.
Yeah.
Michael, we haven't heard you much on this. What is your take actually on the interest rate environment? Thanks, Scott and Laurent, by the way, that was really insightful.
Yeah, Laurent spoke about inflation, and it's kind of like pushing on a string, right? At some point, because you keep printing, and the normal effect, right? The effect that you achieve, right? It's basically diminishing rapidly, and that's what the Fed has been experiencing. But what's really worse is what happened earlier this year when, with the sanctions against Russia, because there's two things that they did, and they really shot themselves in the foot. And one was, of course, freezing Russia's sovereign assets. But I'm not saying it was wrong. I'm just saying there's one thing, there was one measure that was suggested. The other one was basically to kick Russia out of SWIFT. And the West shot themselves in the foot. The Fed, both the Fed and the ECB actually were categorically voted against that, but it was done anyway. And now we find ourselves in a situation where basically, and I don't want to get in detail to that because, Scott mentioned we have a lot to cover, but it's a situation where the Fed is now slowly detaching from the European central banks, and by raising interest rates as it's raising interest rates now, Europe has to follow suit, and they didn't want to. Lagarde, and between Powell and Lagarde, there's not a lot of love lost. So, yeah, I leave it at that. But I think Powell, he doesn't have a choice. He crossed the Rubicon. He's going to have to continue. It took forever for him to be even confirmed, and he has to do this now. Otherwise, the dollar is dead.
So, Michael, what I'm hearing from you, and please correct me if I'm wrong, is that you have America's got their foot on the brakes with raising interest rates. Great Britain doesn't want their foot on the brakes, but they might be forced to. Europe is braking slightly, but they don't really want to. China is back on the accelerator, and Australia is showing signs of being back on the accelerator. And Japan, they promise they won't take their foot off the accelerator. Is that kind of what the overall situation
I'm actually, the point I was trying to make was Powell will have to continue. He's already lagging behind. If you look at John Williams, right, shadow stats, we're not at 8 or 9%. We're much further than that, much further. And pick a number. I mean, just go to the grocery store or fill up your car. So he's always going to limp behind because he can't do what Volcker did, right, in the 70s. He's no Volcker. He's not as tall. Right. So and the Europeans are just that they have to follow suit because the pressure that the dollar now imposes on the euro. So he doesn't have a choice. The Europeans don't have a choice, and Powell doesn't have a choice either. I think we're looking at a high interest rate regime one way or the other. Maybe that temporarily wimp out, but I don't think it's gonna last. They have to, otherwise the dollar is dead. It's complicated discussion, and probably exceeds today.
Yes, yeah. The death of the dollar has been a topic that comes back a lot. I think like we always have to remember when we talk about currency, it's actually a currency against another currency, and that's because like even if one is super inflationary, it's going to depend of. Now it's a bit of the competition of currency. I feel like which one is doing less worse than the other one. It's not even like which
It's
one
the
is
best
doing
looking
good.
horse in the glue factory is the right way to think about it. Like all these horses are fucked. It's like which one is the most fucked and which one is the least fucked. And right now, the US dollar is the best looking horse in the glue factory.
Yeah, that's how I feel about it. But my feeling, another representative saying of what's gonna happen on the market. So yeah, we're gonna keep seeing interest rate going up, and so is there like, because I heard a lot of people now they want to go into bonds because basically they're like, oh, I'm scared of stock market. I'm scared of stock market is going down. I heard the bonds they offer like 4% or something like that. I'm gonna go through that because there's more security and I don't want to leave too much cash in the bank. Well, what is your take on this, guys? Like, what is basically the short-term future of the bonds and longer term, like on the time frame of like the 10 years? What are we going to see with this?
So I might jump in on this one. In the short term, the fact that you can get 4% without taking the risk of the stock market crashing means that that is actually a very appealing risk proposition compared to rolling the dice on the stock market right now. So this causes a repricing of stock markets down. Every time interest rates go up, stock markets get repriced down in a mechanical kind of way. But to me, the bigger picture is that interest rates fell from 1981, that was 17%, to 2020, that was 0%. They couldn't go much lower than zero, but they can go a lot higher. So we have the very definition of an asymmetric risk. You've got interest rates at zero, they could go down to maybe -0.1, -0.2, but they can go up all the way to 10 or 15 again. Like that is a very, very asymmetric positive convexity bet. And the character that we see with all trends is at the end of any trend, you expect it to go very fast at the very end. We saw that in crypto in 2021 in May. We saw that in tech stocks in November, December last year. And we saw it in bonds, interest rates down, bonds up at the COVID highs or lows. That was classic end of trend scenario. To me, the writing is on the wall that the 40-year bond market is over and that you'd be nuts to hold bonds right now. You're going to take a haircut, in my view. And I'd like to ask Laurent what he thinks about. I mean, I know you've been shorting the fuck out of these things, right?
Oh yeah. Sorry.
Look at the look on his face when he says, "Oh, I've been shorting bonds." He's giggling. He's made so much money.
Yeah. Oh yeah. I mean, I'm systematic. So about a year and a half ago, like I started seeing this thing. It's about a year and a half. Let me check. Hold on. Yeah, that's right. It was January and March last year. I'm just looking at my trade sheet. I started shorting them. I got kicked out of one. It was TFT. I short ETFs. And all the way down, and for reasons that probably, I mean, Scott explained. Now you understand why I did it. Thank you very much, Scott.
What is the best vehicle for shorting these pigs, right? Like TBT, TBF.
I'm into BND, BNO. I have three. I got kicked out of one because it was literally a fat finger mistake. I had a good Bordeaux and I pressed the wrong button and oh dear, 100,000 gone. Shit. But yeah, so I showed ETFs. There are probably smarter ways to do it. I noticed that the yield is rising. Obviously, there's an inverse relationship, but still, I mean, it's picking pennies in front of a steamroller. As you said, like all CTAs and everybody has been axed long bond for 40 years. When the trend reverts, this is not going to be pretty, and this is not an overnight phenomenon, and the rent of money is going to go higher. So it's going to reprice stocks lower. People think, oh yeah, stocks are cheap and so on and so forth. No, they're not. They're not, because they're cheap if you use what is that? Cheap money. But if you raise the rent of money, things tend to be very expensive.
Mm.
So this is an interesting point, Laurent. So anyone who's under sort of your age can't even remember investing in an environment where money had a time cost of money. And people have just forgotten that money has a time cost. And I think it's going to be a very, very different environment for professional traders to work through than they've ever experienced before.
What's his name? You know, Dr. Gloom, like the Swiss guy, the Swiss German guy. I remember Mark Faber.
Oh yeah.
Mark Faber, like I remember we were in Roppongi, and he was having a cigar. He was trying to chat up some Nigerian chicks, and he said, "I've had bonds at 14% yield since 1980s. They've done very well for myself." And now you think 14% for perpetual bonds? Wow, dude, you're a genius. But remember that back in those days, you had inflation at 10%. So like, what we think, oh, this is absolutely the best trade of your lifetime, which it turned out to be. But in the context of high inflation, this was, dude, you're crazy. You're going to get laminated. So now our mindset has shifted, like, oh, there's a hunt for yield, and we'd happily take 3%. As Scott said, we'd happily take, oh, I get 2%. But in an inflation environment where you're 7%, unloading those in a couple of years is going to be very complicated. Does it make sense?
Yeah, that makes total sense. Yeah, that's the thing. Yeah, we always have to compare what we're getting for what we are paying, right? And that's interesting. I think we're gonna go closer and closer to the solutions to that, because I think a lot of people here, they allow, right, we know that we have some problems right now, what we can do to avoid this. So we're going to keep moving, and we're going to talk about the interest rate. We had those, and then what are the central banks going to do? That's what I want to know. What is your opinion on this, Mikhail? Like what we're going to see with the central banks?
Well, Paul has zero compunction about cutting the stock market in half. You know, if that means he can manage transition from a unipolar economic model to a multipolar one, right? Which is what we're looking at. There's just not a doubt about it in my mind. And there's simply no other way to save the US dollar, right? But even if they manage to do that, if they can save the US dollar, that old unipolar world that we all grew up in, you know, no matter how old you are, it won't come back. And for instance, Russia and China, along with India, Brazil, Turkey, Saudi Arabia, even joining right now, they will definitely make sure of that. So I think that answers that, right? So high interest rates in my mind.
All right. Scott, you had something to add on the central banks for your side?
Well, I think, you know, this happens about every, you know, Ray Dalio pointed out, this happens every 85 to 100 years, and it has happened every 85 to 100 years for many hundreds of years. You know, we're not the first, this is not the first global reserve currency, which is involving a transition period. And so the last time this happened was in the 1930s, and we saw exactly the same thing. And what did the central banks do in the 1930s? They printed. And why does that always happen? Because politically, politicians will always print money, because printing money is popular and easy, and the politicians are gone long before they feel the pain of that money printing. So my view is that eventually, no matter how tough Powell is, I don't think he'll stay very long. I think the central banks will pussy out and start printing money again. And I think the odds are strong that we end up in a yield control situation where we've got inflation running high and the central bank's saying, fuck it, we're just going to keep interest rates suppressed down here. And we'll have structurally embedded inflation, and most likely, in my view, stagflation. I don't know how the other panelists feel about this, but I think that's the most likely outcome.
Can you explain quickly what is a stagflation, Scott? Because I think it's quite a new word.
Stagflation is a technical term. It's a different type of recession. It's a recession. Usually you have high inflation and then you raise interest rates and that kills the economy. and you get high unemployment, and they're one or the other. Stagflation is when you kind of go halfway towards killing inflation, pussy out, fuck it, turn the printer back on again, and then you get high inflation and high unemployment and a recession and a low growth world. So it's kind of the worst of both worlds. Laurent can probably give a more technical description, but my description is stagflation is fucked.
Worse than recession, basically.
Laurent, can you describe stagflation a bit better than my all-encompassing stagflation's fucked definition?
I think that like in terms of soundbite and punchy, I mean, I think you take it. So yeah, but stagflation is basically what happens is your salary doesn't go up, the cost of everything goes up, and more and more people get laid off. So the definition of a recession is when somebody on your street loses his job and forced to sell the house. A depression is when your immediate neighbors forced to sell your house and everything goes down the toilet thereafter. So we saw that in England in the 70s. It was not pretty. We saw that across Europe, and we might be in for a regime like this. It's a transition regime. But also the stock market, paradoxically, is likely to go up. Now, if you look at Mexico and Argentina and all those places where they had very high inflation, the stock market roofed it in nominal terms, in notional terms, but the value of it was worthless. So that's it. Yeah.
Yeah, and I think, like, could you explain a little bit more, actually, because we addressed that a few times. So, for example, in Argentina, you said the stock market was going up, but it was without value. Can you just give us a little more details about that?
Okay, so the idea is that the peso was devalued. So when the peso is devalued, and Zimbabwe did the same thing as well. When the local currency is devalued, in comparative terms, I can give you the example of the best example I know is Japan, because I lived through that, so I can give you an example. So in 2011, I remember I was shorting the shit out of a few things because we're coming out of a bear market of Fukushima, the earthquake. And then literally overnight, 34 of my stop loss got taken out because Abe woke up and decided, okay, we're going to devalue the yen. So the yen actually was taken down, was very strong, and it propped up over 2 or 3 months. So what happened is, like, the market roofed it. 2012 was a spectacular bull market in Japanese yen. But for the fund managers in Fidelity, like the comparative, those who were denominated in yen, they had a spectacular year. Those who were denominated in dollars, based out of Boston and England, they are like, yeah, okay, Japan did plus 10, 12%, but okay, it's good. It's a bull market, but relative in dollars, it didn't do that much. Whereas for the guys in Japanese yen, it had doubled. For the small caps team, it had tripled almost. So this is what I'm talking about.
So would have been a better position. Would have been a better position, for example, if you're a guy in Argentina and then the inflation is going to the roof, and you're like, is it better to be invested in the stock market or to just?
So, I mean, I have a few Argentinian friends, and Argentinians, by definition, they always revert back to strong currencies. So the national debt is always follow what your central bank is doing. If the national debt is held in Wall Street in US dollars, you should probably hold US dollars. Right?
So Laurent makes a very interesting point here about debt. Not all debt is bad. If your national debt is denominated in your home currency, then you can always work it out. So the American national debt in its own currency, not that big a deal. Like bad, but not that big a deal. Japanese national debt, all in yen, right?
Yeah, 96% held by, and the solution is always you screw the citizenry.
Yeah, you screw the citizenry and you can work it out. And how you screw the citizenry is just devalue the currency. Oh, wow, everything works out. Bam.
Yeah.
But if your currency is denominated in someone else's currency, if you're Taiwan and you've gone and borrowed US dollars, or you're Thailand or South Korea and your debt is in US dollars, boy, you got a big problem when the US dollar goes up, because not only are interest rates going up, your currency's devalued 30% against the US dollar, you owe 30% more. At the same time, you've got inflationary pressure because all the things you're importing, your oil and your heating and your industrial components are 30% more expensive. Like it becomes this death spiral kind of thing, right?
Yeah, that's also something that we saw in Europe, right? Because we get countries with really different type of debts, and then there's only one person who decides who prints. So yeah, because as you guys say, you can always print out to pay your debt because it's just going to work.
And there's good types of debt and bad types of debt, right? Like if I borrow money and I go to university and then I go and earn 200 grand a year for 30 years, that's a really great debt to take on. That is a debt that pays itself back many times. If I take out a loan and then go to a strip club and put dollar notes down a stripper's G-string, that is not good debt. That has to be paid back and I got nothing for it. So early on, you know, the US did things like build their incredible road system, build all their ports, build an education system that was envy of the world, built hard science and put lots of money into that. Those are all incredible, great things to do on credit, you know, but right now you see the situation where China, they have to have full employment. So they'll build a city full of skyscrapers with no one in them. Like build a hole, go and fill the hole in, dig a hole, now go and fill the hole in, dig a hole, fill the hole in. Like that kind of make busy work is a misallocation of capital. And we've gone past the point where we're allocating capital well. And this low interest rate regime, and I think others here would probably chime in that the low interest rate regime has caused a real misallocation of capital.
Oh yeah. Yeah, when you have JPEGs like NFTs, hey dude, this is worth $6,000. Like what? That ugly piece of like what?
No,
$1 million
it's
bucks for a month.
$60,000 or $100,000. Get your numbers right, Laurent, please.
My apologies. My
JPEG.
apologies.
So, as we say, when there is no risk in the market participants will find a way to put risk back in the market. And so are we getting basically, if I hear you guys well, we're basically getting stagflation coming. Yeah, everyone is around the table. You agree with that?
Yeah,
I think that's the highest probability. Like it's not baked in yet. So one of the problems we have is that there's a handful of guys who are deciding which way this is going to go, and here we are reading the tea leaves, going, what's J-Power going to do? What are they going to do? What are they going to do? Like we have a pretty good idea of what they're going to do, but they're still people, so it's a very noisy decision. I think the highest probability by far is that the central banks try, and then politically they can't get away with it, and that people are so used to prosperity that they won't deal with being poor just to kill inflation, and we're going to have to live with inflation. Laurent, Michael, what do you guys think?
well, any remedy to inflation? Oh, Michael, please.
No. You know a lot more about this than I do, so go ahead.
Well, thank you. So any remedy to inflation is like chemotherapy. If it doesn't kill the patient, it's going to be very unpleasant, but you're going to be a lot slimmer. So any remedy to inflation induces recession. Now, the difficulty for central authorities, monetary authorities, is to induce recession without creating a depression, without what Ray Dalio said, like basically, without they want to reduce the price of assets without killing the patient. And this is very, very, very difficult because everything has been inflated. If we look at consumption, I redid some series using the Fed St. Louis. Consumption has been financed by the housing market in the US. Like wage stagnated, more or less stagnated. What is that? Participation, of course, has increased, but consumption has gone more than tenfold. But also, it was in conjunction with the housing prices. And if the asset prices come down, then we have a very, very big problems on our hand. And stagflation is not necessarily a bad thing for the stock market because, as Scott said, they reflate, stock market goes up, then it crashes when they contract the interest. So we saw that in the 30s in the US, we saw that in the 70s until the early 80s in Europe and the US. So for the stock market, there's a stop and go, what was called a stop and go. I don't know if you were born when when people were talking about these things. Michael, I want to hear your wisdom, please.
Oh, me. Well, I agree with stagflation, especially here in Europe, because the situation Europe is in right now, it's not a really good one. I think America is in much better shape. The US is in much better shape because in Europe, think about it. Where are we getting energy from? We're getting it from the US now. What does it get settled in? I mean, when it comes to energy, that's really a big driver of inflation. And we're getting energy from where? From the US right now. We've gotten it from Russia, right? Here in Spanish, we get it done from North Africa. But how does it get settled? Well, until recently, we were able to pay either in dollars or in euros. Now, with Russia, well, there was a deal made with Gazprom that because of the sanctions, it couldn't be settled in euros. So in rubles. So what did they do? Well, they're letting Gazprom actually handle the exchange internally. So it's kind of like a workaround, a cop-out. And so implicitly what this did was Gazprom is in some ways actually a little bit in control of the euro exchange rate. And that's why I said earlier today that Europe really shot itself in the foot. And so Europe is in big trouble, especially when it comes to energy. And when we all talk about inflation, right? Energy consumption and energy pricing is a big driver of that. And again, in US at least,
we got lots to get through. So what I'm hearing from Michael is that particularly in Europe, energy inflation is becoming structurally embedded. They pay for their energy in US dollars. It's a big deal, right?
It's a huge deal. It's a huge deal.
Let's keep it moving, guys. We got lots and lots to get through. We don't want to get bogged down.
Yeah, actually, when we were starting to talk about this, I wanted to talk about the globalization and the supply shock and how that's driving the things right now. Because, I mean, we saw like during those last 2-3 years, massive difference in the supply chain and what have been happening around that. We're going to start with you, Laurent, again. I wanted to know what's your opinion on that, on this supply shock that we see.
Okay, so interestingly enough, I mean, Japan is a manufacturing country. So Japan is quite happy with a weak yen, and they want to bring manufacturing back onshore. So this is also one of the reasons why they're not in a hurry to raise the rate. If they can keep the yen around 150 to low sub 200, it's best of both worlds. They can bring the manufacturing back onshore. So that's a good thing for Japan. As far as the US is concerned, I mean, when you have cohorts of people graduating in gender studies or law school, this is not good for manufacturing, right? So manufacturing stays where the engineers are. And when there's a supply chain exists in China, supply chain exists in Asia, but there's no supply chain in the US. So it's very much a tertiary sector. I mean, it still exists in some parts, but like the brain, like Scott said, Silicon Valley. That's probably my 2 cents on it.
So I think we have to go a little bit before that and say, what did globalization do? So, you know, when I was a kid, you used to buy like a Black & Decker drill or a set of binoculars or whatever, all the stuff that's stored in your garage. Everything would be $500, right? Like a Black & Decker drill was $500, a set of binoculars was $500, whatever, any sort of household appliance, a vacuum cleaner is $500. Now they're all $20 or $30 and you throw them away when they break. Why did that happen? It happened because we outsourced our manufacturing to a place where it was cheaper. And that came with a double effect. The first effect was that corporations didn't have to pay as much for their goods. And they didn't have to pay unionized labor, and they didn't have to pay high wages in it. So it was an enormous boost to corporate profits. The last 20 years since NAFTA and since China got in the WTO, enormous boon to corporate profits, but now a car is made with just-in-time manufacturing. So they use the silicon chip from Taiwan and the rubber from Malaysia and the this from that, and they're all made and they're all assembled like right at the perfect time. And it requires this ballet of global trade working, and it stops working and everything goes to shit, which is what we saw in the last couple of years. Not such a big deal if your garbage from Amazon doesn't come through in the post on time. It is such a big deal if you're Russia and you can't manufacture cars anymore because they need chips that the US won't let you have. It is such a big deal if you're a Russian company and you go invest in the US and they just confiscate all your money. It's a big deal if you're an American investing in China, and China's probably going to tit for tat confiscate your money. It becomes not just a corporate profits issue, but a national security issue. So, what we're seeing is as our wars become more and more Cold War-y, like America and China are in open conflict now, America and Russia in open conflict, that nations can't afford to not have their at least some manufacturing capacity onshore. And that comes at a cost, because of low interest rates and globalization, we put all our manufacturing offshore, and now we have to pay the dumb tax. And the dumb tax is, oh, fuck, we moved too much offshore, let's bring some back. And that is not free, that comes at a cost. So logically, our manufacturing is going to be more inefficient, higher cost. Supply chains are going to keep breaking. Like, I think we're going to see an extension of what we're already seeing. And, I'm interested in what the other panelists have to say on that. Laura?
If you think about, for instance, the technological advantage, like when we're talking about chips, it's one thing to, okay, we want to bring them back, but do you have the manufacturing capacity? Do you have the legacy? Do you have the engineers? And do you have the clean rooms? Do you have all this environment? So it's one thing to conceive stuff in Silicon Valley. It's another thing to mass producing them without delays. And I think that this is far too optimistic. People are vastly underestimate it's like building a watch. Building a watch, you won't get the time right until the last cogs fits in. And if you build an iPhone or whatever, you need those microscopic screws. You need those things. And where do you find the manufacturers in the US for that? Where do you find the manufacturers in Europe for that? They're few and far in between. So there's natural gluts in there. Like, for instance, there's a company in Japan, like a friend of mine invested in it, and they do like it's actually just down the road, Disco. Shoken code, a security code 6146. They just right after Ito Yokado, like literally the place where I go shopping. These guys are micro dicing chips, and they have like 30% of global market share. Period. Nobody comes close. That's it.
Interesting. So
they're literally next to my supermarket. It's funny.
So what I'm hearing from you is that we don't have enough. We'd like to move on manufacturing back onshore, but we don't have enough engineers. That's going to contribute to inflationary pressure in wages. One thing that's come out in our previous discussions is commercial real estate. With everyone on Zoom, are they going to go back to the workplace? And is commercial real estate a short? Like office buildings as separate from onshoring manufacturing and residential real estate, probably pretty good bets in an inflationary environment. Commercial real estate, to me, it's a stinking pig. What do you guys think?
For my own research, what I saw is everyone would agree that, all right, commercial like office and stuff, it's just going to go down. It's just going to go down because I guess when with everything that we say in a climate that is a bit more negative, the ego to have a big or nice office on the nicest streets is not that important anymore. It's not that important anymore unless people would go to the office, a lot more people working online, or they would go to the office with just 2 or 3 days a week. So we're gonna see something happening here because you can't pay those office. And then when we see as well, who was the people buying all those nice office? It was Google, Facebook, Amazon. They were like getting the best office in town. And what are they doing now? Like Facebook Meta just announced they lay off 10% of their workforce. So obviously, if one of the biggest customers of those office is going out, there's going to be interesting things.
Agreed. Laurent, we were talking about the ethical and moral dilemma. Like, I know a lot of people don't like making money off other people's misery. I know you wrote a book on this, like the ethical and moral aspects of profiting on short selling. Can you talk a little bit about how you justify betting that other people are going to lose money? Because I love shorting, and I know you do too.
Thank you. So, market is amoral. It's not immoral. Immoral is doing things that are against the moral, but amoral is the complete absence of morality. Like it's basically, oh, it's not, you don't ask a lion, what do you think about veganism? What? What do you think about Beyond Meat? Excuse me? So the market doesn't care about right or wrong, good or bad. The market is. And if we think about this, a lot of people try to contain it through ESG. To give you an example, we couldn't invest in Toshiba because one of our pension fund had the ESG mandate, and Toshiba makes a component that is used in landmines. Landmines and it's just a chip. It's a condensator or something like this. But this is one of the things that goes into landmine. So ESG has all these arbitrary rules. It's a chick dating by checklist, basically. Oh, he's not tall enough. He doesn't make enough money. Da 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 da. And then this creates imbalances that eventually research somewhere else. They resurface somewhere else. So it doesn't work. Trying to impose morality to the stock market doesn't work. It never did. It never will.
Let's go solution now, and then we're gonna do a quick recap, and then we're gonna go for what are the solutions. So, what I'm hearing from you all is that the big things driving the last decade have been low and decreasing interest rates, boosting asset prices, increased corporate profits from globalization, and low tax rates. The demographic bonanza of the baby boomers and Gen Xers hitting prime tax-paying years, and those low interest rates and central banks' policies have caused a society-wide misallocation of capital. Scott, do you want to add something in? Or
look, I mean, we've got all these stupid food delivery apps. Like there was one went broke in Australia yesterday. Like those food delivery apps couldn't make money when we were all locked in our houses and couldn't go anywhere. That is a stupid idea. And yet, so we invested in those, but we didn't invest in oil wells, and we haven't got enough oil wells. Like this low interest rate thing has caused a society-wide misallocation of capital. We've put our money in the wrong things. We've invested in monkey JPEGs. We needed oil field. We needed oil wells, and we need wheat fields. Like we've done the wrong thing, and fixing that is not free.
And Laurent, like you have, I want your opinion on this.
Oh, the solution. What should we do to solve the economy? Oh no. Man, I need a stiff drink. But you're talking about asset class, or where should we be invested? Is that the question?
Yeah, like asset classes in an inflationary context, like long real estate based investment. Like, okay. What is the?
So I made the best trade of my life. I'm long residential real estate to the tune of 7 buildings, and it's been the best investment of my life.
What do you mean when you say you're long in real estate? You own some real estate for yourself, or you investing in a fund?
So my name is Laurent, right? And a friend of mine calls me low rent. So I'm invested into low rent buildings, and I own 7 of them in Tokyo and Hokkaido. So that's been fantastic. Residential, if you're the owner. Now doing this now is a bit more complicated because we're in a rising interest rate environment. That's one thing. Another thing that works well in an inflationary environment is agricultural commodities. Commodities, they usually rise. I mean, you can't make more gold it's just there, right? Or agriculture, we have 8 billion people to feed, and everybody wants their latte. Yeah. What about you, Michael? I'm interested in your take.
About
what would you invest in? What would be the asset classes that you would?
Oh. Well, you know what to do. I'm mostly in stocks, and not in tech stocks. And no, real estate, no, I never touched it with a 10-foot pole. I'm basically just invested in equities, and equities basically. That's pretty my métier, and some bonds, but in terms of yields and everything, it's again something that I never really pursued very strongly. So it's I've always been equities man. So
that would be, Michael, would it be like your thing for the next decade if you had to pick one
and crypto,
thing?
Of course. Sorry.
But if you had to keep one thing what would it be for the next decade?
What's your best trade? You have one. You have to hold it for a decade.
Well, I would definitely stay in Bitcoin. I would basically definitely stay in crypto. And in terms of equities, I would basically continue to basically equities, just buy the dips. Basically, just buy the dips.
I'm going to disagree with you.
And energy futures is another one. The sky's the limit, really, with energy futures. It won't be ever as cheap as as it was in the 20th century and even early 21st century. I think trend trading is going to be the next thing. The next thing again. I think it's going to be like in the 80s again. Like Turtle, maybe should start a Turtle group. And again, Bitcoin, crypto. It's a long-term buy. Once the final leg has materialized, and that won't happen until I think that won't happen until at least Q2 of 2023. So, and also, of course, with the given the volatile environment, options. I'm just always into options because it's what I do. I'm very good at trading options. So there's a lot of option strategy. I wouldn't call it an investment. It's more of a trade than investment. So when you ask me what investment, energy stocks, nothing related to precious metals or anything like that. No. And then select equities. That's what I do.
I can see you're a really generous man. As for one investment, one play, I got like 4 or 5 things that I was writing down. That's okay. It's good. It gives more solution for the people with us here today. And Laurent, actually, what would you do if you had one play to make over the next decade? You can go max 2, but please say
back in actually the night where we had dinner with Mark Faber, I was asked to do a stock picking contest, and I picked coral farms. So because of the weather is changing, climate is changing, so water would be a commodity that would be interesting. This is something
coral
that
farm. What is that? It's you mean the coral that we find in the sea?
The logic is very simple. Small fish eat corals. Bigger fish eat small fish, and so on and so forth. Here goes the food chain. And at the bottom of the food chain is coral. And if you think that 60% of oxygen is produced by water, within the water, like we think trees do that, not actually. 60% of the oxygen worldwide is in the water, and a big portion of it is within the coral food chain. So people don't know that.
So how do you trade that?
Dude, I won that stock contest. My friend told me a year later we were having he gave me a couple of Dom Pérignon for that. You won by a continent wide. Like that thing, when there was one company, actually French company, that did this coral farming, and that thing went up 7 times.
Wow.
So, but it's super illiquid. Like now it's probably gone 100 times, but it's massively illiquid. Like you have to trade on appointment.
A more mainstream play, like something that, like I'm not going to put my retirement money in coral. Sorry, dude. I'm sure it's a good idea, but I can't. I can't do that. What's a mainstream play, like a energy, like a trend, like a agricultural commodities, like water you mentioned the other day? Like that seems like an amazing trade. How do you trade water?
There are ETFs for water. The problem is that they're not exactly pure play. So they're like water membrane, water purification, water desalination, and so on and so forth. So there are ETFs that do synthetically those. There are funds, active funds that do that, actively managed funds. So,
but for example, for water, I'm like, okay, maybe it's gonna go up, but I don't know. I feel like if it's not going up by 2-fold in less than 5 years or something like that, it's like, why am I even investing in this? So it's like,
well, you've got the last 10 years, dude. So historically, stock markets have done about 6% a year over the last 100 years. The last 10 years, stock markets have done 20% a year. So, so you're used to this idea where it's really easy to make money, and I'm not interested in it if it doesn't double in a couple of years. That is going to be the case with some things, but most things, that's just the old way. This is not the world that we're moving to. Historically, every time we've had 10 years of overgrowth in stock markets, the next 10 years have been undergrowth. Like we're looking at a very, very specialized stock pickers market where, you know, you get the right things and you do really well, and you get the average things and you get a terrible result.
You know, may I say something? And the thing that I mean, the one ring to rule them all is the asset allocation. The thing that we've been working on with Scott, the one ring to rule them all. There's no way of knowing, oh, because we can guess, and sometimes we're going to be right, sometimes we're going to be wrong. But the one ring to rule them all is what we've been working with Scott. Like,
so what Laurent's talking about is we've rolled our own trend following. We've rolled our own trend following program out for crypto, which is really good, and we're going to roll it out for stocks and futures as well eventually. But there's other ways to invest in. So trend, I think, is going to ultimately be the best performing asset class in the next 5-10 years for sure. I think everyone should have some allocation to trend. If you're not a sophisticated investor and you want to do it in an ETF, DBMF is a very good ETF that closely tracks the trend index. It's going through the roof right now. DBMF is amazing. But as well as that, like, I think uranium is a really, really solid play. That's definitely top of my list. Uranium, agricultural commodities like you. And I think if we get the Project Zimbabwe thing happening, precious metals. You know, I mean, gold is very out of favor. It hasn't performed well at all. But if the currency rates go down, you know, at least it's real money.
Well, yeah.
And I know Michael disagrees with me. That's good.
Well, it hasn't done anything. I mean, has it been an inflation hedge? But yeah.
No, it hasn't been. It hasn't worked at all. All the things that people said it was, like Bitcoin's an inflation hedge, gold's an inflation hedge. No, it hasn't been so far.
That's true.
I think that's been wrong so far.
Well, actually, you were starting to talk about this, Scott, because so for you, like, to recap, your number one play, you would say it would be trend following, if I'm right?
Oh, absolutely. Because one of the things that we know is that instability begets more instability. So we've had a very stable world for 10 years. For 10 years, the play has just been buy and hold until we grow old.
Yeah, you know? I see. Well, let's dig in and how would you craft actually the exact perfect portfolio that's unique to you? How would you do that?
So for me, you need some diversification because, like Laurent said, you don't know which of these things are going to work. Like things that sound perfectly plausible don't work, and things that sound crazy actually do work. So you need between 5 and 12 different bets, and they need to be sized according to their volatility. So obviously Bitcoin goes up and down all over the place. It's crazy. So you need to hold less of it than you might hold in an agricultural commodity ETF, or less of it than you might hold in a uranium ETF, or farmland, or whatever the play that you're going through. So from my point of view, the perfect result is probably somewhere between 5 and 12 of the plays that you think are historically demonstrably going to work in a high inflation environment. I think that's what we've got, and that ones that will work in a stagflation environment. And what if we get Project Zimbabwe, which we don't know, which is where the governments devalue our currencies? Hard assets are going to go through the roof. I'm interested in what Laurent thinks about this. I think everyone should have some trend following exposure, and you know, we can talk about, like, there's half a dozen different ways to do that. You don't have to roll your own into a system like we do it. You know, there's plenty of funds you can do it, plenty of ETFs. I'm interested in what the other panelists say.
Oh, I mean, you see that banknote above me, so yeah, the trend following, and this is it. Like this is very difficult to know if, and we all investing has a lot of emotions. For now, we have ideas and so on and so forth, but I believe in systematic trading. I believe also that asset allocation, having the right mix, and also having the right risk appetite. What I've seen through my career is that people get way too timid around the bottom and way too greedy at the top.
And the thing is, for those investment, I think, like, it really depends how old you are, because like, for example, I'm quite younger. Like for people who are in their 50s, they're not going to invest with like someone in their 20s or 30s. So it's like, what would be the, would you have like different strategy depending of how people, how old people are, Scott? Like, would you?
Of course you should, because you know, if you're in your 50s, you can't afford to take that much risk. There are no do-overs when you're 55 years old. If you're 20 years old, you should be taking more risk. You should.
Can I echo on that very briefly? I'm 50. I just turned 52. Thank you very much. I can receive birthday presents all throughout the year, so so it's not too late. But you see, I'm 52, and I know that if I make bad investment, bad choices now, I'm not employable. I can't go back to my friends and, hey, come on, can I work on this trading desk? I said, dude, we can hire a 20 or 30-year-old Ivy League for a third of you and work him to death. You're not valuable anymore. So the dollar that I will waste on stupid investment is not coming back anytime soon. So I have to be very cautious and very wise about what I invest in.
No more Coral stock picking.
Oh man, dude, I'll do that any day of the week.
That's interesting. Okay. And I would like that to go like in details with all the investment we talked about, but like, even if we had the time, I don't think we had the time to go directly into one and the other. Like, do you have like something for us, Scott, here, like to help us to go through this and basically study like those investments one by one?
Okay,
And,
so I mean, personally, I'm big on trend following for the next 10 years, because, and Paul Tudor Jones came out recently and said that if he had to pick one thing for the next 10 years, it would be trend following. But that's because trend following is the idea that you're buying things which are going up and shorting things which are going down. And right now we don't know what's going to happen, so we have inherent uncertainty. So buying everything that goes up means that if something goes up crazy or if something goes down crazy, you're going to be on the right side of it. So I believe that trend following should be a part of everyone's portfolio going forward. But so your optimal portfolio, it's going to be a mix of 6 or 10 different trades targeted for volatility. So volatility is a fancy word for how much something wiggles. If it wiggles a lot, it's high volatility. If it wiggles a little, like bonds, it's low volatility. And it's going to be a function of how much money you already have. Very different if you have to make a fortune than if you've already got a fortune. If you're in the making money game, or if you're in the protecting money game, or if you've got your eye on your retirement and you're in the not fucking it up game. Very different games. And your time to retirement, your utility function, you know, in your 20s, you should be taking more risks. And you know, like we've already talked about. So let's talk about this new economy boot camp that we're starting in a couple of weeks. So we all came up with it together. I'm thrilled to be launching the new economy boot camp, and you can already tell from listening to these guys for now that they're the real deal, right? Like, what we're going to do is we're going to run an 8-week intensive where we go through in really exhaustive detail the 10 best wealth creation opportunities for the next 10 years. So we narrowed it down to all of our best 10 ideas. And these aren't trades. So it's not like, you know, Michael and I would usually hold trades from a few days to a few weeks and very occasionally a year. This isn't like that. This is more like portfolio investing where where unless something goes really, really drastically wrong, you're planning on holding it for 5 or 10 years and riding the wave to the beach. And so these are 10 investments that you can make, sit on your hands for the next 10 years while everyone else who's going to buy and hold, because buy and hold investing is going to get completely wrecked. I think, to me, that is very, very obvious. What I want to do is see you guys on the right side of everything. But on top of that, like, there's not much point saying, okay, we'll get your retirement accounts to where they want to be in 15 years' time if you don't have enough money to put into your retirement account. So you need cash flow now to generate cash. So building wealth over the next 10 to 20 years, that's fine, but you can't really worry about building wealth if you feel unsafe now. And you can't worry about building wealth if you can't afford to live the life you want to live right now, then, you know, who cares about building wealth? So now more than ever, my opinion is that cash flow is king. So what we've come up between us, between all of these guys here on the call, is our ultimate cash flow generation bundle. And here's how it's worked. Here's how it works. So everyone on this call has taken all their best stuff, all their best trading systems, some fully automated, some semi-automated, and we've thrown them all into this giant bundle that we're going to give them. So let's flesh that out. So Michael has the best cash flow systems of anyone I know. Michael, have you got handy your options, real world option returns for some of your systems? Because they're just nuts. Do you want to share your screen, bro? And
Yeah, real quick. Yeah, if you might.
just quick.
1 second.
I mean,
Yeah. Just 1 second. Yeah. Okay. If I see it, I just took a snapshot here. Okay. All right. Can you guys see that?
Yep.
oh,
Okay, so that's the last year, and okay, yeah, will every year be like this? I I hope so, but it's been a good year, and I've been trading conservatively, right? This is
86 wins and 16 losses, like that's bullshit, man. Like, and these are real world. This is not backtest, right?
yeah, this is really well. This is posted. This is with my subscribers. It's live. It's traded live, and it's not like back test or anything.
So tell me how what's the basis of this system? Tell me how the system works. Like,
So when it comes to options, right, and I'm really all over options, it's always based on market weather, right? What are the market conditions, and they change. So we adjust basically our strategies accordingly, right? For example, over the past year, what we noticed, SKU, right, like difference between out of the money options and at the money options, has been highly elevated across the board.
no, you can't get too nerdy here, dude. Like, so,
Okay.
but is it once a week system? How does it work? Do you have
Okay. It's like we're taking a trade every other day, so to say, right? And and we just basically adjust our strategies according to what the market is doing. So in very simple terms.
And you've got a number of different systems.
Yeah.
Is that the best one? Is that the overall? Like,
I've done very well with this one.
Yeah, this one. I mean, this one's amazing. So what other systems are you putting into this bundle?
It's Gravitas as well. I also took a snapshot. Here's Gravitas, and basically you can see that. I hope you guys can see it on the screen. You can see where it went long. It went long down here. It's basically just trend following. Like we've been talking a lot about trend following. And that's what it does because
so Gravitas is a swing trading system.
Yes, it's just a signal, and
it's a longer term. It's a longer term.
Long term,
and it comes as a signal service. So you don't have to know any rules, right? Like you just get a notification on your phone, and you take the signal, and it's done really well, and it's short now, right?
It's been short, and look here, right here. It's been short from here to here, and it's been short from. I'm not sure you can see it on my screen, from here to here. So it's caught all the major swings over the last 2 years. So it's done extremely well. Let me stop my share.
So you've got so tell me exactly which systems are going into this bundle too. So
it's basically what I call RPQ unlimited, which is basically options trading. There's a whole educational section, and of course the signal. So what we spoke about, the trading that I've done over the last 2 years, it's done live. So you're getting basically the alert in our trading forum, which is online. And you get it live, you get it, as that's what we're doing right now. We're also getting the exits, of course. So that's that. There's educational material. We're going to have a whole series on that starting in January again for more educational stuff, if anyone is interested. And of course, we have Gravitas, which I'm also throwing in, which is basically crypto. It runs on Ethereum and Bitcoin. And it's, again, long-term. It's basically a long-term swing trading system. So you don't have to worry about, hey, is there going to be, what is crypto, what is Bitcoin going to do next? Is it going to go, long-term long, or should I be short?
The whole times are a month to 2 months kind of thing, right?
Yeah, you hold for weeks. You hold for weeks in this case. So it's not like swing trading or anything like this, no.
Okay, so the next thing that I want to move on to is that crypto is in the shitter right now. But historically, if you only bought crypto when people were saying that crypto is dead, you would have done very well. So if it's, I don't think it's the right time to buy yet, but I think we're close. But when it is the right time, what do you buy? So Antoine has this really incredible software as a service that he's developed, which is a fully automated balanced portfolio system. Antoine, could you flesh out a little about how that works?
Yeah, I can share it quickly. So basically, I came up with the idea mostly for myself because I know that every crypto ride, there's always a big train coming up. So what you can see is in 2018, 17, it was the ride of the altcoins mostly, like whatever altcoin it was, like you should be in, and then you will have made a lot of money. And there's in those times there was also, after we had we had for the trend of like 2020, 21, it was the DeFi. So if you win DeFi, it would be good, and then you would have made money no matter what you bought in DeFi. And then after we had recently, and before the crash, we had the metaverse and all those NFT coins. So I came up with the idea to basically create, similarly to ETFs, a basket of different assets depending of their class. And you can just replicate the basket by clicking on one button, and then it places the order for you on Binance. So I wonder with this way, because it's much easier. Like I can create a new basket in less than 5 minutes. So if there's a new trend in crypto, I can be on it directly, and then it's going to be automated for my portfolio. So that make it a lot easier for long-term investors when we're going to be again in a bull market. You know that you can directly say, okay, yeah, I believe in DeFi, I can invest in this, and you just replicate that.
And while we're here, I'm interested in your opinion. The next round, you know, there's always another crypto bull market because we know the crypto is like an idea virus that catches fire. Next round probably won't be layer one coins. Is it going to be DeFi? Is it going to be metaverse? What do you think is the hot sector that's going to really outperform?
Yes, so that's really an interesting question, and that's a question I ask myself almost every day, because we can't know exactly yet what it will be. We can have some tendencies. Like I feel like it would be more DeFi. Why? Why it will be more DeFi? Because, well, we had a major central exchange that just fell down. So like when there's one actor like this that's so, all right, centralized exchanges are shit, and then we need to go decentralized exchanges. So that could be it. The thing is, DeFi is not that user friendly yet. It's not easy for everyone. You can't have it on your phone and then click buttons like a monkey to buy and sell shits. So there's a lot of controversy, and I can't know exactly yet. Metaverse, I would say meh, because it doesn't seem to be an interest of anyone for now. And I think like some people like want to go away from screen and then more into their screen. So we will see how it goes. And maybe there's another one that we don't know yet, because that's how a DeFi happened. Like DeFi came up like in less than 6 months.
So let's get back to your system. So this works with an API connection to your broker. Which brokers does it work with?
For now, it's Binance. For now, we use only Binance, and then maybe later we're gonna add up some other ones. But as you know, choosing a broker those days is harder than choosing a girlfriend, I would say.
Well, at least you developed it for Binance. I developed my trend following system for FTX. So that was,
yeah. And actually, we had the question at the beginning about like if something else going to take over Bitcoin. I just wanted to add something is, you can kill whoever you want on the planet. It's not going to change anything to Bitcoin. And I think you cannot say the same thing about a lot of crypto, because the way that Bitcoin is being created, the way it's been distributed, make it stronger than any other coins, as we can't trace who created it. And that's a major things compared to other things. Like if tomorrow Vitalik died, Ethereum is going to take a major hit, like no matter what. So yeah, I just wanted to add this up.
So one thing I think we skipped over, which we probably shouldn't have, is that Michael, you were talking to me about how Gravitas, your crypto swing trading system works, and not to get too much into the weeds, but it's using a Kalman filter, right?
Kalman filter, yeah, it's basically used in navigational system. It's in computer simulation. It's in GPS systems. Airlines use it. The NASA uses it. So it's been used in engineering for a long time. And I looked at that and I thought, this is an awesome algorithm without getting too nerdy. And why couldn't I use that for price predictions? And that's what we did, and it worked as you saw right on the chart. It worked very well. So yeah.
Okay, and there's no actual thinking not like some of my systems. No. You have to actually learn the rules and practice the rules. No. There's nothing like that. It's just you just get you get a notification, sell this thing, buy this thing, right? It's that simple.
Yeah, it's basically getting an alert every day. It's either flat or it's long, and it doesn't change very often. So if it changes, right away, you just look, okay, are we still long? Okay, we're still long. Okay, oh, we went just short, or we're flat right now. So it's super simple. You're getting an alert every day. That's
Right.
what it works.
So I think we got to keep moving on. I want to talk about a subject that's close to my own heart, which is the best performing system I've ever sold isn't my own system. It's a system that I stole off Laurent, who showed me it. We were he came and visited me in Bangkok, and we had a little, like, I show you mine, you show me yours session, and yeah, I sold Laurent's system for many years, and this system, it's a system for catching short squeezes, and it was so incredible. During that, like, Wall Street Bets, AMC Mania stuff, it painted 18 winners in a row, like 18 consecutive winners. And I thought it must be fragile, because, like, how can anything do 18 in a row? And Laurent, could you tell us about your wonderful system, which I've really enjoyed stealing, and at least I give you credit for it. Can you tell me how you came up with that idea and what it does? Like how does it work?
Time you kiss next time.
You get a little kiss next time.
Yeah, here. Yeah, kiss me here. Kiss my neck next time. So, as Scott mentioned, it's the precursor of Wall Street Bets. It's 10 years younger than Wall Street Bets. The idea is we go for the most. My universe is usually equities, but I think it would work in the crypto, like as we saw with the funding rate. But the idea is to go for the most shorted issues. So that means that the people don't short stuff that goes down. They short ideas. They're negative on ideas. So it's very much sentiment driven. So when people short a lot, these are razor thin margin. And then when you see the prices moving up a little bit, you just come in and make as much noise as possible. You sit on the bid. So the last guys who jumped in, oh yeah, man, this is the short of the century. This is a structural short. This guy will probably have his stop loss triggered. Then the guy after this, because when all the selling pressure is exhausted, things tend to rally up. Then the next guy will have his stop loss triggered, and so on and so forth. So before you know it, you have a full avalanche of stop losses. And the reason it's very predictable.
It's a mechanical thing for identifying when short squeezes almost have to happen, right?
Yeah, absolutely. And it's very metronomic. Like you can tell, okay, this is super heavily shorted. Price is moving up, so selling pressure is over, time to buy. And if you come and just tilt the what is called the bid-ask spread a little bit, then you trigger an avalanche.
So I've traded this thing quite extensively, and I've never seen a system so accurately. So let's just recap what we're doing. So what we're really doing here is we've got an 8-week course where we're doing a call every week. And over those 8 weeks, we're going to help you define your ultimate portfolio with the best probability trades for the next 10 years. As well as that, we're all chiming in to give some of our best stuff away. Michael is contributing all of his options trading systems, which are amazing for cash flow. Antoine is contributing his software as a service, which does rebalancing of crypto portfolios, which is a very useful service. I've also got a byproduct of the research that Laurent and I have done into trend following. We have, let me just share my screen quickly.
Yeah,
so,
I wanted to see this actually.
So this is really cool, right? So our trend following algorithm is really a blend of 30 different trend following algorithms, and we average them out because one system could be wrong, but 30 systems on aggregate are probably going to be right. And we list our top bullish and our top bearish forecasts. So how do you use this? Very simply, anytime you're holding an altcoin and it goes on to these top bearish forecasts, you don't hold any of those. Like anything that's any of these are getting fucked. These are in the getting fucked business. And anything that is going to go to the moon, before it goes to the moon, it pops up on these bullish forecasts well before it starts to go. So what we see is this same cross-sectional momentum behavior that the AWCE was based on, whereas the winning stocks, the winning coins, or the winning stocks, or the winning everything runs out to a lead. People notice it because it's going up faster. They buy it because it's going up faster. It goes up even faster again, and now it's off to the races, and it's got a lead. It's what happened to Doge. It's what happened to Sol. It's what happened to AVAX. It's a very, very repeatable behavior. So the way this works is this is on a web page. You get a password to it. You can just check, as often as you want. Are the coins that you're thinking of holding the very strongest, or the coins you're thinking of holding, are they on the weak list? If they're on the list that's going down, you don't want to hold them. And so in my opinion, this is like a superpower for if you're going to trade altcoins, this is a superpower for altcoins. And in my opinion, altcoin trading is all about outliers. So, if you get 1,000 to 1 on a coin and you have $1,000 in that coin and it goes 1,000 to 1, like Shiba Inu did, that's $1 million, right? Like even if you only have $100 on it, that's 100K. So if the game is all about catching outliers, and that's what crypto trading is, you're trying to get the moon mission coin, then this is the perfect tool to catch them well before anyone's ever heard of them. And we tested that every coin that blew up last cycle was well in advance of the news, well in advance of the Reddit and the Facebook groups. And so in my opinion, this is the simplest but the most useful thing you can have for altcoin investing. So we just went through a lot. Let's just recap it again. So the main thing, like what I really want you guys to take away, is an 8-week live intensive with me and everyone else. And we're not going to teach you how to trade. We're not going to do any of my usual nerdy bullshit. We're just going to dish the results, like educate you about these 10 big trades. Now, at the end of that 8-week intensive, you're going to know exactly how to position your investments for maximum growth. And just as importantly, what investments you shouldn't touch, what investments that are definitely going down. And at the end of it, you'll have this anti-fragile, and anti-fragile is very important. So we're not just looking for a portfolio that can handle a few punches or handle if we go into recession. We're looking at an anti-fragile portfolio as a portfolio that if we get COVID-20, COVID-21, monkeypox, if we get, nuclear war between Russia and the US, if we get China invading Taiwan, if we get trade wars, cold wars, hot wars, if we get a new plague that no one's ever heard of, anything bad going to happen, we want to position ourselves not just to survive that, but to benefit from it. And so we're going to get you at the end of it, you're going to have an individualized portfolio for your time in life, for your wealth right now, or your 401k retirement account or superannuation fund. You can just sit back and watch that compound over the next few years. And the idea is not just surviving in a low growth world, but outperforming. And on top of that, we're going to hand deliver to you on a silver platter a bunch of different ways to generate cash flow right now. And those are Michael's Options Unlimited system for generating weekly income from options in an hour a week. Amazing results, amazing real world results. Michael's got his really famous now stock statistics scanner for identifying the historically most optimal times to buy, sell, or hold any stock on the S&P 500. And it offers you 21 key statistical graphs for any stock symbol you plan on trading. Michael's Gravitas crypto swing trading system for picking long-term swings in both BTC and ETH page. It's got every major move of the past 2 years. It's a slower system, so it's not in and out every week. It's in and out every couple of months. And the system that I borrowed off Laurent, his squeeze box system for capitalizing on situations where an asset is crashing and it's about to bounce very hard. It's a very, very useful system. Incredibly high win rate, and my crypto trend forecaster that you can use to get a live list of all the top bullish and bearish cryptos in real time. So, of course, you're all wondering about the price, and all these trading systems, these are incredibly valuable. And, I'll give it to you straight. Usually you should expect to pay between $3,000 and $5,000 to learn any one of these things. So most of you have paid me $5,000 to learn something off me at some point and gotten good value out of it. And plenty of people on this call paid $12,000 to learn my system directly from me. That's what I charge to learn directly with me. And plenty of people here paid Michael that as well, and Antoine as well. And Laurent, you can't even pay him to do it because he earns his money from an actual job, like an actual professional. So you're getting all these things for free, but what you're really paying for is this anti-fragile, balanced, risk-adjusted 10-year portfolio, which we're going to deliver to you in the 8-week intensive. And I know most of you are going to expect us to charge like 10 to 20K for something like that. And I think that would be pretty reasonable value, but we're not going to do you like that. I'm not even going to charge you 5K, which I know is what you're all thinking, because I always charge 5K for everything. And I'm not even going to charge you half that. And here's the deal, for Black Friday, I wanted to offer the absolute best deal that we've ever offered on any single thing. And here it is. So you can get the 8-week intensive new economy bootcamp, Michael's Gravitas system, our stolen version of Laurent's famous squeezebox system, our crypto trend forecaster giving you the strongest trending coins in real time and coins you absolutely don't ever want to hold, and Antoine's portfolio basket software as a service. You can have all of this, which is conservatively worth 30K, and I'll give it to you this week for just $2,000. Right? Best deal I can do. I said I'd give you a good deal, and that is a hell of a deal. And here's how you can get it. In your email right now, you have a doc, or someone from my group is going to probably post it in the chat. That is USD, Lawrence. And someone always asks. Someone always asks. You don't ask, you don't get if you don't ask. So fair play to you. So here's how you get it. In your email right now, you're going to have an email with a Google Doc outlining absolutely every single thing that you get, when the calls are, et cetera, et cetera. And at the end of that Google Doc, there's a link. Click it, fill out the form, and get you enrolled. And yeah, let me. Can someone post? Can someone from our company post that in the chat, please?
Yeah, it's posted. I can see it. Jan posted it.
2000 FTT. I don't even know what an FTT is anymore. I mean, honestly, there will be no ever better deal than that. All of these systems are great systems. Everything we're doing here is great. I just want to thank everyone for their time. Laurent especially. Laurent's been a fantastic mentor for me for years and years and years. And I love working with him, and I love learning from him. And Michael and I built our first automated trading systems together in 2012. You know, we've traveled and met up in real life, and we've built probably half a dozen different trading systems together now.
Yeah, absolutely.
Successful time every time.
Crazy Ivan.
Crazy Ivan back in the day. For Val, who's here, we automated Ivan's old stuff. That was the first thing. That was the first thing that we did. Yeah, I just want to thank everyone for their time, and you'll be getting an email with the recording. You'll be getting an email with the Google Doc, which explains exactly what we're doing. You've got 1 week to decide if you want this. This is the best deal that you're ever going to get on anything from me. Like, yeah. Thank you so much.
Well, thanks everyone. Yeah, it was amazing conversation. I learned a lot. So thanks, Scott, Laurent, and Michael, to share all your knowledge. That was really valuable.
And thank you, Antoine, for your for hosting. And you know, we didn't get to hear much of Antoine about his actual knowledge, but Antoine's knowledge in the DeFi space is just unparalleled. So everything he says about crypto, I take very seriously, and you should too.
Thank you, Scott.
All right, guys, we're going to wrap it up.
Yep. Thanks,
right.
Antoine.
Thank you.
You're welcome.
Thanks, Ron.
My pleasure,
Thanks,
guys.
Scott.